Well, let's get started with the show today. And today on the show, we are being joined by Shweta Rajani, the head of mutual funds at Anand Rathi Wealth. Let's welcome her on board. Shweta, hi, and thanks so much for taking the time out and joining us today. Let's start by talking about the role that taxation plays in one's investment decision-making process, and to what extent must investors be wary of tax when they are deciding where they want to invest and where they want to park their money.
Hello, good evening. Since we're talking about tax and investments, both are actually, I would say, interrelated. And when you are taking your investment decisions, one of the factors that one must look at would be taxation. Generally, when we're looking at our investment opportunities, we would look at what can be the return expectation, what's the time horizon, what's the risk factor. Like that, I think liquidity and tax implications should be one key factor for determining whether you should invest in that instrument or no. So it should be, I would say, a key selection criteria, while it should not be the only selection criteria. And one more thing is that when you are looking at investments and taxation, I would say it starts from the day you start planning your investments. You should also start planning your taxes, and it should not just be the end of the year activity. So, that's the relevance. It's important criteria, not the sole factor for your decision making.
All right, and well, the 31st March deadline is approaching rather quickly. So, help our viewers understand. Let's break down all the tax implications that come with it, and let's understand which incomes are charged under the category of capital gains, because we do have LTCG, the long term capital gains, as a component of the tax that we file. So, help us understand what exactly makes up this capital gains.
Absolutely. You have various heads. If you have any interest income or dividend income, that comes under your income from other sources. Like we're talking about capital gains. So any investment that you could have had, let's say in gold, and you're selling it, that will comprise as capital gains. So any capital asset that you've held, if you've held real estate and you've sold real estate, that again, depending on the holding period, will categorize for short-term or long-term capital gain. You could have had unlisted equity or listed equity, that any gains made on that. Debt, again, you could have debt mutual funds, you could have, some bonds that you've sold. So again, listed bonds or unlisted bonds, either ways, will again come under the head of capital gains. So a simple definition, like I said sometime back, any capital asset sold will have an implication of capital gain.
Shweta, and let's talk about one concern or one area of interest that a lot of our viewers have now. What are some of the tax provisions which every taxpayer should take advantage of in order to save the tax that they're paying?
Right. So, under the tax laws, I think, we all would have heard of Chapter 6, and that's where you have various sections. You'll have Section 80C. Now, this is a tax advantage or an exemption that everyone should avail of. Up to an extent of 1,50,000, you can make investments under Section 80C and claim the benefit of it. A common investment avenue here is your PPF, which has a 15-year lock-in, and you'll get a 7.1% interest rate. That's the most commonly heard of. But you have various other options here. You could have tax saving FDs, which have a 5-year lock-in again. But I would say that the most attractive option here, and something that everyone should do, is the ELSS, or equity linked savings schemes, mutual funds, which you can invest into and get the benefit. They are equity oriented. So the capability in terms of return generation tends to be higher and can be double digit. It has a 3-year lock-in. So this, I think, should be one advantage that a person should take. Second, if you've just started working, then you could have had a higher education loan. So under Section 80E, any interest that you are paying on the education loan, you can get the benefit of that too. Employee provident fund, again, if you are a salaried person, then up to 7.5 lakh of employer contribution towards PF is again exempt, and then the employee contribution gets added. So that's one more advantage that one should avail of. On over and about this, you can also have an NPS that you can invest into up to 50,000 rupees, and you can get the benefit of that. Lastly, nothing to do with the Chapter 6 exemptions, but you are under the section of 112 allowed to book capital gains to the extent of 1 lakh, which would not be taxed. So every year, if you have any equity mutual funds, then or debt funds, you should look at booking that 1 lakh of gain, which would be tax free for you. So a slightly long answer, but yeah, these are certain provisions that you must avail.
All right, thanks for taking us through all of those options. Now, you did mention two options, PPF as well as NPS. So, take us through the advantages and disadvantages. Let's talk about the PPF first, because it's a guaranteed fixed amount of interest that comes from the government. So, it's rather safe. The risk amount is low. But on the other hand, it also comes with a 15-year lock-in. So, take us through what other advantages and disadvantages are there when it comes to PPF, and also when you weigh it against NPS, which one would be your preferred form of investment?
Sure. So, like I mentioned, PPF comes under Section 80C. So, up to 1,50,000 of investment every year. If you avail, the tax on that amount is exempt. Interest on the contributions made is exempt. It has a 15-year of lock-in, so that's a disadvantage. But the 7.1% of interest that you're getting is kind of tax-free. Uh, and like I said, the downside of a PPF it would be the 15-year lock-in and a 7.1% of rate of interest. Because if you compare it to the other ATC options that you have, like an ELSS, you can get a double-digit return there. Now, NPS is over and above the exemption of 1.5 lakh that you can get in the PPF. But in an NPS option, the money is locked in till the age of 60. So, let's say you're just 35 years and you've, invested in an NPS, your money is going to be locked in for that 25-year period. So that's a downside, that you have a, slightly longer holding period. Second, the maturity, that's at the age of 60 years, only 60% of the pension amount accumulated can be taken as upfront or lump sum. The rest of it is paid out as annuity. Now, when that annuity is paid out, it will be paid out to you till your life, and that's going to be taxed to you at the slab rate. So, the advantage is that if you are investing, you can invest in both the options, PPF as well as the NPS, because it's just add on to the PPF advantage. However, given that you'll have your money locked in for a longer tenor, as well as not the entire amount that you get towards maturity would be tax free, I would say it is an avoidable app or option. Because if I'm going to stay invested for 25 years, why be an NPS and still get that 6.5-7% return? I can not worrying about the tax exemption, invest in pure equity for 25 years, I'll end up with 12-13%. So the difference is I'm getting 7%, which is tax free to a certain extent, but on the other hand, I'm getting 12% in an equity fund for a longer tenor, and I'll pay a 10% tax. So post tax, an equity fund for a 25 years can still give me a 10 double digit return. A pension would give me 7% return. So it's not, to my mind, worth it if you have that longer tenor. But PPF as an option, if you have, you can avail or go in for an ELSS.
Shweta, that's my very next question, that if you have to pick between a PPF and an ELSS, which one would you pick? What's your preference over any ELSS schemes that you would recommend for our viewers?
Sure. So, like I've been mentioning, let's compare it on terms of return. PPF gives you 7.1%. ELSS, if you look at the long-term track record of equity, you can get that 12, 13, 14% return. So, on the basis of return, ELSS scores over. In terms of lock-in, PPF has a 15-year lock-in. ELSS has a 3-year lock-in. In terms of, if I look at the tax benefit, both of them are at par because both of them fall under that ATC category. So my obvious, choice becomes an ELSS in this case.
All right, Shweta, and let's now talk about the whole factor of inflation, right? So, help us understand the entire concept of indexation and how viewers can take the benefit or take the help of indexation and make their tax filing even more effective.
Yeah. So, the concept of indexation is, or, I'll take a step back and say, whenever you're computing your capital gain, it is sale value minus the purchase cost becomes your capital gain. Now, the purchase cost that you apply in certain instruments, you can adjust it to the cost of inflation. So that's your indexed cost of acquiring that product, which basically means, let's say you bought an instrument uh, 3 years back at 100 rupees, but the average inflation for example purpose has been 7% over the last 3 years. So now your indexed cost would not be 100, but your indexed cost would be somewhere around 124. Let's assume your sale price is 140 rupees. In this scenario where you've got the indexation benefit, your capital gains is going to be 140 minus 124, which is roughly 16 rupees. In case when you did not apply the indexation benefit, your capital gain would have been 140 minus 100, that is 40 rupees. So in effect, because you've got that indexation benefit where you've been able to inflate your purchasing cost because of the inflationary impact, you are getting an advantage of roughly saving 24 rupees of uh, capital gain on your books. So that's, indexation. How you can get it? There is a cost of inflation index that is published by the government every year, which tells if you've bought an asset class in, let's say, 1970s or 1980s or whichever financial year, what would be the equivalent indexed cost for it. So one can apply that ratio and compute your indexed cost. This is available on a couple of instruments. So if you've purchased real estate, and that could be a major component of capital gains for a lot of clients who are holding real estate, you can apply the indexed cost. Sometimes, even on unlisted equity, you can get the benefit of indexed cost. Plus, if the viewers remember, till last year, prior to March, we used to get the indexation benefit even on debt funds, but the rules were changed in March 23. But still, you'll have certain types of mutual funds today. Call them as dynamic asset allocation or multi-asset, category of funds or hybrid funds, where you have equity which is less than 65% and debt again which is less than 65%. These are still available for this benefit of indexed cost to you.
All right, Shweta, thanks for breaking that down so brilliantly for us and our viewers. But stay on with us because it's time to slip into a very short break. But when we return, we'll be talking about how you can make your investments more tax efficient. So stay tuned to the show. Hi there, welcome back. Thanks so much for staying tuned. You're watching The Money Show on ET. Now, we still have Shweta Rajani on with us. Shweta, hi. Welcome back and thanks so much for staying tuned. Help us understand how an investor can make his or her investments more tax efficient. What are some ways in which they can do that?
Sure. So, while a person should avail all the provisions and exemptions that are available, but I think in terms of, looking at your investment portfolio and trying to make it more efficient, there would be, 2, 3 options that one still has. For example, if you're looking at debt as an investment option, then, rather than going in for fixed deposits or debt mutual funds where the taxation can be around 30%, you can look at alternatives. So, one example here would be going for an arbitrage fund. From a risk perspective, it will form in the lowest grid of risk. It can give you around that 6 to 7% return, at times up to 8%, but it gets taxed as equity. So if you're holding on for more than a year, then your taxation would be around 10% here and not 30%, which you would have otherwise paid. So that's, one way of making your portfolio efficient. Second, I would say sometimes, people still go in for a dividend option. But clearly, if you're going in for a dividend option, that's going to be taxed to you at the marginal rate. So you can go in for an SWP if you're a mutual fund investor. So, a systematic withdrawal plan, and there taxation becomes more efficient compared to a dividend plan. Third, I would also say that it may be making sense to gift to your family members some of the amount and to not go in for clubbing provisions there, because then you will be able to spread out your investments, and that would make it a lot more efficient. Lastly, like I said, Section 112A allows you to book capital gains of up to 1 lakh and not pay any tax on it. So that is something that you should definitely avail, and small things, but definitely would go a long way in saving taxes.
All right, Shweta. Now let's also talk about senior citizens, right? Where should they be investing in order to save tax? What are some of the schemes, some of the exemptions that the senior citizen category, what can they avail?
So, all the sections that I mentioned during the show, which are available to a normal, youngster, is also available to a senior citizen. But a senior citizen also has an option of a senior citizen FD, which you would get it at around 7.5% kind of a rate with a 5-year lock-in. Of course, the interest payment is taxable here, but when you're making the initial 1.5 lakh of investment, that comes in as a tax exempt option. So that's an additional advantage that is, or an avenue that is available for a senior citizen. However, I would say that, if you do not need the money for 5 years and you're willing to lock in that money, then, some portion of this can also be parked in an ELSS and try to get that slightly higher return. Some options that they should avoid clearly would be a PPF or a pension, which have longer time periods, or going in for insurance policies, which again would have a longer tenure. That is something that senior citizens should definitely avoid. Anything which has like a 3 to 5 year lock-in is something that they should opt for.
All right, Shweta, thanks so much for taking the time out and joining us today, and for enlightening our viewers on how they can play around with tax and how they can save tax while filing it for this 31st March deadline. But earlier in the day, we did manage to speak to Chirag Setalwar of HDFC AMC, and he's saying that as the market continues to hit fresh life highs, getting your asset allocation right is the most important factor. He also adds that investing systematically is the second most important factor. Let's go across and listen in to what he had to share with us.
The younger you are, the closer you should be to 100% equity. And as you become a octogenarian and so on, as you become older, you want to have 100% of your money in fixed income, right? So it all depends. You have to look at each individual's profile. But asset allocation is the most important. People spend too much time trying to select the right fund and the right sector and so on and so forth, and they don't look at the bigger picture. So get the asset allocation right is the most important. Invest systematically, and I think that now has at least fortunately caught on, is the second most important. And the third, which we don't do very often, is to take advantage of market dips, right? So, how many people invested at the bottom of COVID? How many people invested at the bottom of the financial crisis, right? It's tough times to invest in, but it's fantastic from a return standpoint.
Alright, that's the word coming in from Chirag Setalwar. But viewers, with that, I'm afraid we're completely timed out on this edition of The Money Show. From me, Snehisha, and the team that put this show together, thanks so much for watching.